Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today's video is about big real estate tech companies that are buying houses. These companies are called iBuyers, and do they actually make money? The answer is no. They're actually losing billions of dollars. We have the data. We're going to show you these amazing graphs. Really quick, Juana, in general, how does an iBuyer work?
So an iBuyer is an institutional buyer. That means it's a company, right? That purchases homes usually from an individual, and the way they make money is they make money from buying right, not on the selling end.
Okay, so they flip the house. They're flippers.
They are.
Okay, 2021, the greatest year of all time for buying and flipping, because prices were shooting up. If you bought a house and sold it 3 months later, you had to make money on it, right?
Right.
So you would expect all these tech companies just made killing in 2021, right?
Well, they killed it, just not necessarily in the way that they had intended.
Okay, so we're going to start. Now, I'm going to put the first slide up. These are Opendoor net losses starting in 2017. These are not my slides. These are pictures of slides I took at a real estate tech conference. Juana and I go to a real estate tech conference every year called Inman. There was a presenter, Mike DP. His website's down there, MikeDP.com. The guy is probably the premier real estate tech analyst for those types of companies. He is very well aware of how these companies work. Opendoor has not ever made money, and in 2021, the most robust and easiest market for flippers to make money, they took a beating. They lost $1.6 billion. Their market cap, if you look at their stock price, it has tanked over the last 3 years. Just tanked.
Right.
I have more slides to show you, but how is it in the most robust year ever that you could lose this much money? Like, why is this possible?
Well, I could say really, really mean things, but I will refrain from that.
Yeah, refrain.
Okay, so let's kind of start with a little bit at the beginning with Opendoor. So Opendoor raised a ton of capital, so they had lots of money to spend.
Yeah.
They went out and they bought homes, and what they try to do is they try to buy homes under market value, and then they would turn around and sell them for market value. But when you're buying homes, even if you're not doing any repairs or renovations, there's a cost, not only besides the purchase price, but there's a transaction cost when you're buying, there's a transaction cost when you're selling, there's a holding cost because you're spending all this money. So all of this kind of conspired against them, and they just didn't do very well. They lost billions of dollars, as only a large corporation can, because the rest of us could not sustain those kinds of losses and still keep breathing. So that's what happened with Opendoor. Zillow kind of went down the same path, but at some point they cut bait and they said, okay, we're done. We're not doing this anymore.
Okay. Now this is interesting. Zillow lost $1.5 billion,
Yes.
Okay, trying to flip houses. They realized they weren't going to cut it, and 2021 end of the year, they said, hey, we're not going to do this anymore. We've lost over $800 million total just in that year. So they cut bait. Now, surprisingly, they just announced today that they're partnering with Opendoor to be an iBuyer and merge the effort to do. So they're going to try to join forces and try to do iBuying together. My guess is it is an attempt to sort of push out. There's a lot of smaller players doing iBuying, and they're just trying to be the one thing, like monopoly. Because once you get a monopoly on this, it's much easier to do that, right?
So I have two things to say about that. One, both of these companies have so much cash that even though they've lost billions of dollars, they seem to be unfazed by this.
Yeah.
And the second thing is that I don't know how this is going to play out, because they are such big players. I can't imagine that somebody in the government isn't looking at this and saying, is there like an antitrust thing going on here? I'm not really sure. So it'll be interesting to see how that plays out.
Yeah. There has been interest from the Federal Trade Commission on Opendoor. They did get a big fine. We did a video on that.
Yeah.
Now we're going to look at Compass. Compass has had $1.7 billion in net losses. Compass is more of just an online real estate brokerage. They have offices. They're very high tech. They haven't made money. They're also extremely well funded, billions of dollars of venture capital, loans from banks, and things, debt, and things like that. So three massive, probably the three largest real estate tech companies, Opendoor, Zillow, and Compass, just getting hammered. In 2021, your average real estate brokerage, all the franchise brokerages made money.
Right.
Like EXP and Keller Williams and Realogy, these companies were making money. Small brokerages were making money, agents were making money, loan officers were making money. There was a lot of deals happening, people were making money, but the tech companies were not doing well. So what does this look like starting today? I don't have the chart, but I saw a chart that was put out like a week or two ago where it showed the number of homes in inventory, and then it had Opendoors, and it just shot up. Opendoor is sitting on tons of houses that they haven't been able to sell. I'm going to predict by the end of this year that they'll have an even bigger loss than they had last year, because they're going to be stuck with these houses that they can't sell. They are one person that has to sell. Like, they have to sell because they're not renting them.
Right.
And this is something that could hurt short term hurt the housing market. These guys are just going to say, we got to get rid of these things. Let's just dump them cheap and sell them.
So kind of three things to that point. One, Opendoor, as far as this inventory that they're sitting on, they're going to do one of two things. They're either going to do regular price reductions until the house sells. So that's an opportunity if you're a buyer.
Yep.
Or they may pivot and they may partner with somebody to rent these houses out. That is a possibility.
But remember, they've borrowed. This isn't their venture money. This is money they borrowed. They probably have loan covenants against doing that. And then if they don't get the money back, they can't go buy again.
Well, but remember that all of these companies are sitting on so much cash. So look, these companies are sitting on so much cash that they can try all kinds of different business models until they hit upon one that is actually making them money. They actually have that luxury that most of us don't have. They have the luxury of losing money until they come upon a business model that works and they can make money.
Okay, let's talk about that from you understand business very well. People probably out there don't realize how well you understand business and all the aspects of it. As a company, how is it possible to not even have a business model that has traction, that has product market fit, and go out and just raise billions of dollars over we're going to do this thing and we think we're going to make money, give us billions of dollars? Like, what? Honestly, I mean, we're not talking about a small startup that's raising $100,000 on a small valuation that's trying to create some new thing, to have pizzas delivered to your house, like via a drone or something, right? This is, we're going to go out and raise billions of dollars and we're just going to buy houses and flip them. And this is, we wrote down, we put some numbers on paper. It says we can make money doing this. And then they're bleeding cash.
Yep, they are. They are hemorrhaging cash, but they don't seem to be daunted by this. And they're not daunted by it because, like I said, they're sitting on tons of cash. And they're just going to keep trying until they come upon something that makes money. And remember, these companies are backed by people who have had successful ventures in the past, and they have a lot of credibility in the marketplace, so they can go out and raise more money. Because you've got people who have had all kinds of successful business ventures, and we can talk about Opendoor has Shamath.
Shamath.
Yeah,
he's one of the.
Yes, he's one of the investors. Zillow has their own people. So all these companies, they do have major participants that have a lot of traction and a good track record.
These specific three companies, this is Silicon Valley.
Yes.
These are Silicon Valley startups. Zillow's not based in Silicon Valley, but the money comes from that ecosystem. It's the West Coast startup, thing. Specifically, Compass and Opendoor, San Francisco.
Yes.
Zillow's based in Seattle, but all that money is basically the money started there, and Seattle has the same thing. But this is not like a bank in New York that is running a hedge fund or something, a big financial institution in New York City. These are tech enabled platforms.
Absolutely.
Zillow, Opendoor, and Compass all have one thing in common. They're claiming their tech is greater than whatever else, and they can do a better job with the tech. The tech lets them be more profitable, more efficient, and certainly when companies are scaling, they don't make money. Uber hasn't ever had an annual profit. Airbnb, I don't think, has ever had an annual profit. They're growing, they're doing stuff to try to get there. It was argued that if Uber just raised their rates a quarter a mile would become profitable, but they're still competing and trying to get market share, whatever. Airbnb just had their highest increase ever in bookings, right? So they look like they're something that they're going to come out of this. But these are huge losses. Like these, and if you look at their stock prices over the last 3 years, these are These are like potential. Like if you think these companies are going to be around for a long time, then go invest because they're super cheap compared to where they were 3 years ago. Like some of them are substantially cheaper.
Right. I mean, I honestly believe that at least 2 out of 3 of these will be around for the long term, but I don't expect that they will be around in their current incarnation. I think that their business model is going to change. I think that they have to, because clearly what they've been doing thus far has not been working.
Yeah. It'll be interesting to watch this. Of course, we're, as you know, because of our referral cloud startup, we do understand, and we're very, very well informed in the ecosystem of real estate tech startups. We know a lot of the people that are involved in a lot of companies that are doing things similar to this. And so we are going to track this. This is something we're going to keep our eye on. But when I saw the slides, I didn't know these exact numbers, and I took pictures of them. But MikeDP.com, that's the site. If you're really a super real estate geek, go to that site. You can check everything out. I think he's got a newsletter you can subscribe to, so subscribe to that. And what else?
So if you like the video, please hit the like button, hit the notification bell, subscribe, share the video, leave us notes, and if you have a particular interest or anything that you'd like us to consider or maybe do a video on, feel free to put a suggestion down in the comments, and we will try to do a video on your suggestion.
All right. Thanks for watching, and see you on the next video.
Bye.
Bye.